One of the biggest questions that every single investor struggles with is how to determine the value of a stock. Warren Buffett, known to be one of the best investors of our time, has a famous quote that says, "Price is what you pay, value is what you get." Price, of course, is quite simple to define. Price is the number that you see the moment that you look up your favorite stock on your brokerage account. It is the price that a stock currently goes for on the open market. But then what exactly is value and how do you determine this? Well, taking a definition from Investopedia, they say that a value stock refers to shares of a company that appear to trade at a lower price relative to its fundamentals, such as dividends, earnings, or sales, making it appealing to value investors. A value stock can generally be contrasted with a growth stock. And I think there's a few problems here with this definition. Namely, in the final part of this definition, a value stock can generally be contrasted with a growth stock. Because I think this part of the definition contradicts with the earlier parts. Let's have a look at the company of Apple. We see them steadily grow their revenue as well as their EBITDA by about 10% annually for the past 10 years. Many people would consider Apple a growth stock because they've been heavily outperforming inflation for the past 10 years. The moment that you look over at their share price, however, you realize that Apple is the biggest company in the world and currently trading for $191.33, which is arguably not a discount to its underlying fundamentals. But let's see what happens if we actually just remove the first two numbers from their share price and say actually the price suddenly came down a lot because I don't know, maybe the Apple car has claimed its first victim and the price dropped dramatically to $1.33. At this moment, I would argue with the revenue and EBITDA that we've seen on the left hand side for the past 10 years, if you can buy Apple for $1.33, it's absolutely a value stock. Just looking back at the definition again, I think at this price point, this company's stock appears to trade at a lower price relative to its fundamentals such as dividends, earnings, and sales. Absolutely, without a shadow of a doubt, I think it will. And at the same time, it's also growing their revenue and earnings like crazy still. So at that moment, this stock would be considered both a growth stock and a value stock. I do not think that these two terms are on opposite sides of the spectrum. I think a growth stock can also be a value stock. And value here is very much dependent on the future cash flow that a company will generate in your favor. Let's take, for example, two companies. Company A has a current earnings of $1 per share and has been growing their earnings by 25% for the past 10 years. They're currently trading at a share price of $10. Company B, however, is also currently earning $1 per share, but is growing their earnings by 2% every single year for the past 10 years and is also trading for $10. Which of these two companies would you rather invest in? Of course, this question is a no-brainer. Obviously, you would invest in Company A because the moment that you actually project their earnings growth for the next 10 years, you realize that in 10 years, Company A will make $7 per share while Company B will only make $1.20. It's a no-brainer to invest in Company A as opposed to Company B if the prices are the same. But obviously, this isn't always the case. Let's say that Company B is fairly priced for $10, then what exactly would the share price for Company A be if they are growing that much faster? And this is where we start to look at market multiples. And there are several multiples that you can look at. The most famous one being price to earnings multiple, but another very important one is the enterprise value to EBITDA ratio. The definition of this is enterprise multiple, also known as the EV multiple, is a ratio used to determine the value of a company. The enterprise multiple, which is enterprise value divided by earnings before interest, taxes, depreciation and amortization, EBITDA, looks at a company the way a potential acquirer would by considering the company's debt. What's considered a good or bad enterprise multiple will depend on the industry. I think if you want to make this definition easier to understand, I would argue that the EV/EBITDA ratio basically says how many years does a company need to run with its current earnings before interest, taxes, depreciation, amortization to buy back the entirety of their enterprise value, to buy back the entirety of their company on the open market as well as their debt load. Let's take, for example, these two companies. We've got Apple on the left-hand side with an EBITDA growth of 9% and an average multiple for the past 10 years of 15 times. On the right-hand side, we've got Nvidia, which has been growing their earnings by 23% for the past 10 years and is currently trading at around 35 times. Because their earnings are growing a lot faster than Apple's is, they are currently trading at a higher multiple, a higher premium, because of the future cash flow that they can expect. If you buy Nvidia now and hold it, let's say, for a decade, people expect their returns to vastly grow in 10 years because of the growth that Nvidia has been seeing for the past 10 years. If we take a very exaggerated look at what these kind of growth percentages would look like, we see here on the right hand side Apple, which is slowly but steadily increasing their earnings in a very linear pace. And on the left side, we've got Nvidia, which is currently trading at a way lower earnings than Apple, but at a certain point, because of their high growth rate, they will start to accelerate their earnings like crazy, which you can see here in the final part of our little graph here. And basically what you're interested in as a value investor is all the area below the blue line, because of course this is your pro rata ownership of the company. Let's say that this is the cash flow that each of these companies produces. This is the cash flow that's belonging to you as an equity owner. This is all the money that goes to you in the form of dividends or share buybacks. This money is going into your pocket one way or another, and you want to maximize the number here. And this is the reason whenever I look at a company, I look at the 10-year time span previously to see exactly what kind of multiples and what kind of growth I can expect. And then I try to project this into the future of the next 10 years. Because the moment that you look at Nvidia, for example, right now, their earnings compared to Apple are quite low. But the moment that you look 10 years from now, you can expect Nvidia to really ramp up their earnings, which will also increase your return on the stock as well. So I always try to look for a 10-year time span. And then I look exactly what I think the stock price will do over those 10 years. And I will also take into consideration the free cash flow that the company would generate, because of course that money is going directly to you as well. And I include that into my calculation of the IRR, the internal rate of return. And this kind of normalizes the return that you can expect on a per dollar basis. So now to bring it to a conclusion and to really try to simplify everything that I've told you during this video, I think the definition can be summed up as the best value stock concerns the highest amount of future free cash flow that you can expect to receive from an investment over a set time span. Thank you very much for watching. Don't forget to like, subscribe and all that good stuff, and I'll see you in the next one. Cheerio!